mortgage credit certificate can help you buy your first home. It's only available when you get your first home, and it can give you a tax break for as long as you have a mortgage on that house. Mortgage credit certificates are actually quite amazing. And in the last video that I did, I talked about mortgage credit certificates, or MCCs, from a kind of a broad, a more of a general explanation or an overview of what mortgage credit certificates are. So if you haven't already watched that video, I recommend you go back and find that video just to get a background on exactly what a mortgage credit certificate is, how it's calculated, what the benefits are to you, and what your responsibility is in order to take advantage of that. Because here's a little secret about mortgage credit certificates: you have to bring it up. If you don't bring it up to your loan officer and they never bring it up to you, and then you buy your first home, you missed your opportunity to get free money for the rest of your life, as long as you've been in that house, by not taking advantage of that tax credit. So today, what we are going to do is I'm going to talk about how mortgage credit certificates are treated for each agency. So these are the all agency guidelines. Now, what does it mean when I say all agency? So there's basically 5 different, we're calling them agencies that can, so an agency developed a standard for underwriting guidelines for that type of loan. So Fannie Mae and Freddie Mac are both conventional underwriting guidelines, which means that they're not government underwriting guidelines. But Fannie Mae, even though it's conventional, and Freddie Mac, even though it's conventional, they treat things a little bit differently. Then you have FHA, which is a government insured loan, VA for veterans, and then USDA for rural development, which is 100% financing in census tracts that are less densely populated than your urban or maybe even some suburban areas. So let me blow this up a little bit bigger. So let's start with Fannie Mae. So this is Fannie Mae conventional. So if you're applying for a Fannie Mae conventional loan and you want to get a mortgage credit certificate, this is how the mortgage credit certificate is calculated. So first of all, you're going to treat the mortgage credit certificate as income. And I go through this calculation in the overview, but essentially what you're looking at is you take the mortgage amount times the note rate times the mortgage credit certificate amount divided by 12. So here's an example. Let's say you have a $150,000 loan and you have a 6% interest rate. So that's $9,000 so that's $9,000 in mortgage interest that you're going to pay in the year. $150,000 loan at 6%, that's $9,000 in interest. Now you take 20% because your mortgage credit certificate is 20%. And again, you might want to go back and watch the other video, but essentially you're taking 20% of the 9,000 and you're able to use that as a tax credit every single year, a dollar for dollar tax credit to reduce the amount of taxes that you owe. What you can also do is you take that, so that's $1,800, 20% of the $9,000 for your mortgage interest. That $1,800, 2 things are happening with that $1,800. That $1,800, the first thing you're going to do, and again, we reviewed this in the other video, first thing you're going to do is you're going to reduce the deductions on your tax documentation. So you're going to have your employer take less taxes out every year, or out of every paycheck, because you have an $1,800 tax credit. That's $1,800 in taxes that you don't have to owe. The other thing that you're going to do with Fannie Mae is you're going to take that $1,800, divide it by 12, which is $150, and you can add $150 a month to your qualifying income. Let me say that again. When you use a mortgage credit certificate, it is not only helping you on your tax, it's not only helping you on the money that you're bringing home from every paycheck. You can adjust your deductions, your withholdings, so that you can bring more money home, so that you don't, because you already are anticipating not having to pay the taxes at the end of the year. Then you're going to take that savings and you can use that as income for the purposes of qualifying for this mortgage. $150 a month doesn't sound like a lot, but it could be a lot of money in purchase price. It could give you that wiggle room that you were looking for. And quite frankly, it's $150 to help you qualify that you didn't have before. So if you're applying for a Fannie Mae conventional loan and you want to use a mortgage credit certificate, that's how it's going to be treated. They're going to treat it as income for calculating. Now, what you're, yeah, I got a little typo there, so let's get through this. Now, your lender, remember, your lender is going to submit a copy of the mortgage credit certificate. All of this has to be done through your lender. So you can bring it up to your lender that you want a mortgage credit certificate, or to research MCC programs. They will do that for you. They have to look it up and they have to file on your behalf. So the mortgage credit certificate, they're going to submit the copy of the mortgage credit certificate from the county or from the state housing finance agency. They're going to submit that to the lender, to the investor, in order to do all the calculations. Now, it's okay to refinance if you have a mortgage credit certificate, but you need to obtain documentation from the mortgage credit certificate place to make sure that it still stays in place once you refinance. So this, again, if you have a mortgage credit certificate and you're refinancing into another Fannie Mae loan program, you need to let your lender know that you have a mortgage credit certificate, and they need to follow up to get the documentation in order to make sure that you preserve your mortgage credit certificate moving forward. Okay, that's Fannie Mae. Freddie Mac is going to be very, very similar. Actually, Freddie Mac is going to be exactly the same when it comes to this. They're going to treat the mortgage credit certificate as income. So the calculation, you're going to take loan amount times note rate, times the mortgage credit certificate percentage, divided by 12, and that amount is added to your income. Same scenario that we did before. The guidelines for Freddie Mac do not mention a mortgage credit certificate through a refinance. Now, when an agency doesn't mention the guidelines, when they're silent on a guideline, usually the lender is going to come up with a guideline of their own, or they're going to use the guidelines from a different agency. So this is going to be a situation where you're going to just have to talk to your lender. And if you know that you're getting a Freddie Mac loan, so this might be it. If your lender is trying to put you into a Freddie Mac conventional, and you have a mortgage credit certificate, and they don't know what to do with your mortgage credit certificate, you might want to look at maybe Fannie Mae guidelines, because Fannie Mae guidelines absolutely state it. Chances are most lenders are going to use the Fannie Mae guidelines if you're refinancing into a Freddie Mac conventional loan. And all that basically means is that your lender is going to have to get the documentation for the mortgage credit certificate, and they're going to have to forward that to the new investor so that the investor can preserve the mortgage tax credit. Even though you refinance, you want to make sure that all that paperwork is in place. FHA, if you are trying to buy a home using an FHA mortgage, again, they're going to treat that as income. It's the same situation. It's the same calculation. You're going to take the loan amount times the interest rate. That's your interest, times the mortgage credit certificate amount, which is typically 20%. Again, the math is gone through in a lot more detail in the other video where I do the overview of what a mortgage credit certificate is, how it's calculated, and how it benefits you. These are just the particular guidelines for each agency. Now, the VA mortgage credit certificate calculation is going to be the exact same thing. They're going to treat it the same way. It's going to be treated as income. Now, in order to qualify for a mortgage credit certificate with a VA, you have to have been honorably discharged, and you can not have used a mortgage revenue bond program before. And you are exempt from the first-time home buyer requirement if you're a veteran. So you can actually get a mortgage credit certificate if you're not a first-time home buyer. With all the other loan programs, you have to be a first-time home buyer. That's the only time you can apply for a mortgage credit certificate is as a first-time home buyer, unless you're a veteran. If you're a veteran, you can remove the first-time home buyer requirement and still qualify for the mortgage credit certificate. Now we look at USDA. So a USDA loan, the mortgage credit certificate is the same. The calculation is the same. They're going to use it as income. Again, note rate, loan amount, times your interest rate is how much mortgage interest you're going to pay per year. 20% of that mortgage interest can be divided by 12, and that dollar amount can be added as income for qualifying for that mortgage. It goes into your debt to income ratio. That's part of your income calculation. So I went over this pretty quick. Again, most of the math is done in the overview video, but I wanted you to see that all 5 agencies, Fannie Mae, Freddie Mac, FHA, USDA, and VA, will all allow mortgage credit certificates. You have to apply for the mortgage credit certificate as a first-time home buyer prior to or at the time that you qualify for the mortgage, because again, the mortgage credit certificate is going to be calculated into the way that you qualify for that loan. And the paperwork can only be done at the time of application. You cannot apply for or qualify for a mortgage credit certificate after you've already bought your first home. So is a mortgage credit certificate right for you? It's hard to say. There are income limits. There are loan amount limits. Income limits for qualifying for the mortgage credit certificate. But now you're at least empowered with one more option for maximizing the benefits of home ownership. Now, whether it's right for you or not, we don't know. We have to do the math, but at least you know that mortgage credit certificates exist now. And not only do you know it, you know how to talk to your lender about it. And you know that there's options based on every single program. So if you're talking to your lender about mortgage credit certificates and they don't understand what you're talking about, we can help you on the Find My Way Home at findmywayhome.com. So findmywayhome.com is a network of mortgage professionals, experienced mortgage professionals from all over the country that care about guidelines, that care about helping consumers. These are not call center lenders. These are folks that are willing to listen to your story, help you figure out the problems. We are guideline geeks and we are tenacious. We do not like to say no. It's usually not now. So how can we help? You can ask a question below, depending on where you see this. If you're on YouTube, you can leave a comment below. I'll answer every single question. You could go to findmywayhome.com and go to the directory, find a mortgage expert near you. If you scroll to the bottom, you can find the states. If you turn on your geolocation, it might give you a little notice. If you turn that on, it'll show you loan officers, mortgage experts that are here to help answer your questions. Also, if you're watching this on YouTube, every Wednesday, we're going to do a live question and answers. And there's more links in the details for you to reach out and ask your questions. This isn't a sales pitch. We are a community of loan professionals that our goal is to keep you out of call centers, because those call centers, they don't know about these programs. They don't bring them up to you, and they're costing you money. So if there's anything that we can do, we are here for you. We want to be your first choice for a second opinion. So thanks for listening. Again, if you have any questions, ask below and we will answer your questions and I'll get you pointed in the right direction. Thanks for watching.